morning momentum, as we always do. We'll talk about the macro, the three big stories that are driving the markets this morning. And then at 9 o'clock, stick around because we will be unveiling the runner. We had a big win yesterday on JOBY Aviation as the stock continued to break down on the backside of weakening momentum that we have been outlining here in the recent weeks, talking about how to trade the morning trade. There's Eric in Northport. There's Randy. Good to see you guys. Good morning, Rodney. Then we'll be asking you in a little bit what tickers you got. We got some time left. We'll take a look at tickers that you want to see, just analyze a couple of different names. We did that yesterday. We've got the opportunity to do that again. Good morning, Connie, and good morning, Rosario. Why do you join us at 8:45 in the morning? Well, the answer is pretty simple. We want to focus on the stocks actually worth engaging and trading today, talk about what the market is doing after yesterday's mild sell-off, nothing too significant, but we did see momentum start to flow out on the Russell 2000, and we saw a little bit of chop on that FNGD. So we will continue to be focusing, again, on what to trade, and I promise you today, you will have charts. I assure you, you will have charts, as that'll be part of our top screens, stocks to trade and strategies for the day. Good morning, Stardust. All right, so we start on the easy side, and this is with momentum, and this is the S&P 500. We had strength heading into yesterday. We've moved to a -4 on our intraday reading, and why does that matter? Because we have to start paying attention. This is wrong. Russell is yellow. Forgive me. I did not update that. We'll talk about that in a second. But as we note, one of the things that we're constantly paying attention to is stocks breaking out versus breaking down. And we'll take a look right now at the Russell 2000 that has effectively taken us to a period where we are a little bit concerned about ongoing weakness in the stocks in the Russell, given the fact that they are a strong representation of the U.S. economy. And when we get into these negative territories, or we get into the yellow territories, that's where there creates opportunity for us to start targeting the Russell itself, the IWM, using any number of different things that we want to trade around. But right now we look at this, we have 117 stocks in our breakdown intraday figures. And on the other side of this, 117 currently, and on the Russell side, on the upside, 117 to 54. It is not entirely negative because, as we will show you at the moment, the triple bear ETF on the TZA, the Russell 2000 leverage, is still holding above its below its 20-day moving average. But we are seeing more flow, more stocks being impacted on the Russell at the moment. And that is obviously a little bit concerning given the fact that we have Jackson Hole coming up and a significant focus on the labor market and what the Federal Reserve might need to do to provide accommodation. Good morning, Secret Agent Charlie. We were worried about you. All right. So you have that in play, and we're watching what's going on with the Russell. With the S&P 500, when that figure goes negative, we turn our attention to the FNGD, which did crack above its 20-day moving average. And that is just a sign that we need to be paying attention to the possibility of some leverage checking out of the system. Doesn't necessarily mean that there's going to be a big event. Could just be a one-off, or a possibility that if we do see a sell-off, the S&P 500 could turn back to its 20-day where we sit right now, or could retest its 50-day. Anything under here, that's where we would be concerned. That's where you have the Evercore figures and expectations for a 7% to 15% correction. It all really comes down to Jerome Powell's ability to thread the needle. Based on FNGD, do we hedge? Not yet. No. We do not need to do that yet. Instead, be paying very close attention to the SH, which is the inverse ETF for the ProShares S&P 500. Once you get above this moving average, that becomes an opportunity for you to buy cheap insurance by buying calls on the SH going out a week or two, instead of trying to fully hedge or sell off to move to cash. We will continue to guide you through this. Again, Russell is yellow at the moment. Significant amounts of selling that we have seen in the last couple of days, and we'll continue to monitor that, and also keep in mind with the Russell, you can short it looking to do potential spreads from here to here, green to red. But one of the other tools that you have is the RWM, which is the ProShares Short Russell ETF. And once again, once that pops above its 20-day moving average, looking for a move to its 50-day and see if it breaks above that level or just tests that level and then returns back. But just for now, this is typically the way that I trade it. If we get above the 20-day, I buy at the money. I sell out of the money toward the 50-day moving average in case it rolls back over. Well, what we have here is a tight stop based on the ability to sell that call. It allows us to protect ourselves from potential downside. It's just a safety trade. When we get above that 50-day, that's where I tend to be a lot more aggressive in trying to short the Russell and shorting the S&P 500. All right, on the macro side, so that everybody understands, this retail is going to be in focus today, but as we know, there's significant emphasis on what's going to happen on Friday. But I'd be remiss if I don't talk about this briefly, particularly Target falling 10% despite beating earnings. The COO is going to become the new CEO, which very exciting. Congratulations on all of your success. As we look at this right now, Target, I want you to keep a very close eye on this because, again, this is all about volume weighted average price and what price action looks like today. Once the market goes open at 9:30, there's a possibility that we see some significant move downward. There's a possibility that we revert. But I keep reminding you that when it comes to earnings, it's not about trying to trade in terms of being proactive ahead of the earnings event. When you have a big move down on a very popular and very liquid stock like Target, what is going to happen in the next 30 minutes of this market could potentially be very lucrative if you trade it the right way. And the way that we tend to focus on this is using volume weighted average price. Specifically, what we're looking for, this is this blue line that's right here. This is volume weighted average price, the 1 minute volume weighted average price. And what we're looking for is for after the stock has fallen from $106 all the way down to 95 is a potential reversion at some point today to the upside. So specifically what we are looking for are one of two conditions. The first is as we move into the day, the expectation is each of these deviation bands, which is one standard deviation, two standard deviations, three standard deviations from this blue line, the volume weighted average price, which is an institutional price anchor that is utilized by algos during the day and institutions when entering and exiting positions. If this sells off to the third standard deviation into the fourth, there's an opportunity for a reversion or a reversal back to the upside because, as Druckenmiller noted and I wrote about on Monday, trend has vanished from this market because of algos. And this was a speech that he gave, or an interview he gave to Real Vision back in 2018. So what you're looking for is the possibility that this stock drops all the way down into this range around 90 and then starts to peel back during the day. The other way to potentially trade this is look for this stock to rebound at some point and move above volume weighted average price. Hopefully there is an ascension in the VWAP line during the day. And what you do is just simply trade the stock, buying it over volume weighted average price, this blue line, and then allowing it to run, not using options, simply just focusing on the stock itself. If there are very wide bands, we're talking about the possibility of $3-4 per deviation band, depending on the early price action. So once again, this is the typical way that we prefer to trade post earnings, largely because it is an opportunity for us to react and to set lines in the sand on where we are going to take profits and where we are going to protect ourselves in real time. Simple? Good. Lowe's is up 3% despite beating its guidance. Despite it beat its guidance, it raised its guidance, and an $8.8 billion acquisition. Everybody's happy, but Lazy Boy investors are not. Lazy Boy fell 25%, LZB. Same story here, right? Same story here. Huge move down on the stock. And now the question is, does it revert? Does it start to get some bottom buying? And do we start to see some short covering that may have been anchored to this stock heading into the earnings event? Another just simple way to attempt to trade some of these names, and once we get toward Friday, continue to look toward these previous day volume weighted average price as anchors, as potential moves back up for the stock in the coming days. And if that is the case, you're simply buying the in the money or at the money calls that may expire hopefully this Friday to try to take advantage of any reversion, but keep a very tight stop if doing so. The core thing that we want to just continue to focus on is taking what the market is giving us. And again, one of the core things and more important things to keep in mind is as we look at these consumer cyclical companies, there is wide divergence in what's happening in this market. And this is very critical. It's very important for us to assess the fact that if consumers are not buying furniture, they are tapped out. So I want you to just keep this in mind before we start talking about what I would prefer to talk about, which is commodities. But in this environment, there are going to be relatively wild swings in a lot of these consumer cyclical stocks. And this feels like just a preview for the fall as we continue to assess the jobs markets and the state of the U.S. consumer. Because again, if the U.S. Bureau of Labor Statistics was keeping tabs properly on terms of how many people are in the workforce based on certain metrics from just a year ago or 2 years ago, the U.S. Unemployment rate would be somewhere around 4.9%. This is why Friday is going to be so important, and this is why the Federal Reserve is putting such an emphasis on the jobs market as we head into the Jackson Hole Symposium. Again, the markets are building on the anticipation of Jackson Hole. Yay! There was a deep conversation yesterday by one of the Fed governors who effectively laid out how the United States government will self-fund itself for a while. The crypto stablecoins are now going to have to be backed by US T-bills. Anyone who wants to buy USDT, which is a stablecoin, in order to buy any of the crappy cryptocurrencies that exist, they now have to buy the US dollar to do so, which is hilarious given the fact that the entire premise of this was to escape fiat currency. The crypto bros, as you know them, effectively built an infrastructure of backing the US dollar for free. That coffee's terrible, but it works. All right. Why only trade stock and not options on the mean reversion move? Because if you have wide spreads on the options, your slippage off the bat can be a problem. In addition, it is more disciplined to trade the stock. And largely because options, what will happen is if you are buying something in the money and you start to slip a little bit, one of the very first temptations that you may have is just to allow it to go down a little bit more and then hope that it comes back. This is simply an exercise in showcasing the importance and the value of trading volume weighted average price and not being reckless about it, simply because, again, the volume weighted average price could tick above that line and then easily roll back over. And the same thing goes with options. I prefer to focus on volume weighted average price reversions with options when utilizing VWAP and Bollinger Bands, but heavily focusing on the most liquid stocks and focusing on companies like Tesla and NVIDIA, which will soon have zero-date options, and the SPY, the Qs, and the Russell, which already have daily options. All right. Fed meeting coming up. Great. More of that. Why did I write July? Oh, yes, forgive me. July minutes come out today, so we will get a little bit more insight into what's going on in the disagreement between the members of the Federal Reserve. That comes out at around 2 o'clock today. 85% probability of a rate cut, according to CME FedWatch. On top of that, the odds of a 50 basis cut have dropped. That's a shame. 47. Again, going back to this, if you look at the comparisons of where we were back in August, 1 week, the odds of a 50 basis point cut have dropped from 65% down to 47%. The odds of 75 basis points have vanished. So we continue to assess this at the moment. And in fact, if you pay very close attention to this, you're actually seeing 6.7% probability of no cuts in the next two meetings. That is starting to get priced in, and a lot of the emphasis and the expectations for December are starting to vanish, as well as we are still pricing in the probability of no cut here in December. I am in the 25 basis point camp, but I think it's coming in October. I think September is going to be fascinating, and I have a feeling that this jobs report is going to be interesting in September, but I think inflation will still be high. So a lot of caution in futures trading. Keep an eye on the SPY, the Qs, the TLT, the XLF, and the XLY, and I will be remiss before we drop the runner into the chat. I have to mention that oil prices have increased by 1% on falling crude inventory. Gold is steady and copper is flat. Expect that to be a little bit different in the coming days. An energy leadership change. High Arctic Energy CEO resigned. Didn't even know it was a company. Just wanted to talk about it. All right, let's get into it. We have, it's 9 o'clock, and I know you got some questions. I'll take a look at it real quick. Heard some interesting commentary from Bloomberg yesterday with Fed, others mentioning levels of debt from poor to rich people and the levels starting to converge. Don't need to see a link on that if you don't mind, Edwin. I would appreciate that. And again, 9 o'clock after we give you the runner, make sure you click on freeze points because Gianni is going to be back here today at 2 o'clock to talk about his coat, his nice winter coat, because again, he's talking about different ways that stocks chop around, don't do much, and then all of a sudden, after they have frozen, absolutely will break out for massive gains. All right, so what do we have today on the runner? Again, this is only issue 7, and if we go back to yesterday, which was our major number one move here, JOBY. And as I said, you're paying very close attention to that 20-day moving average, breaking down further, selling that spread. If we hit and touch that 14, that is the exit. Okay, don't sit around and hold it. Take the gains. Don't be afraid to take gains. That is the purpose of the market, to sell. So this is a tip sheet of the stocks we're looking at to actively trade when the bell opens, stocks that break out, stocks that breaking down. And we start the day with, well, I'm going to do 2 on the breakout side, and I'm going to leave the interesting automotive company for everybody else to debate in a little bit. But here's EPAM Systems coming up above that 50-day moving average. And this is one of those names, one of those trades that I simply state, look, the momentum is here. Trade the momentum, ride the momentum, and either buying the stock or simply setting a stop back here at the 165 level. If we look at EPAM's options chain, see if we have anything here that's actually worth anything. It is an extraordinarily widespread, unfortunately. So one of the things here that we're just trying to do is showcase on the momentum side. Look, this is a stock that has really gotten beaten up, that has been on the move. We're at 24 times earnings, relatively stable on its income, very strong. Coming off this backside on momentum, everything is checking the boxes here. I think there's a possibility, obviously, to the upside on the 187 level. So a couple of shares can't hurt. Stop is tight back here at the 165 level, or if you're a little bit more adventurous, take it down to 161, which is the 20-day moving average. We're looking for the 20-day average to continue to move higher. On top of that, well, let's talk about it. MGM waking up, not looking for a ton of a move here, given the fact that we've stalled out twice at the $38 level. But obviously, there is activity here, and there is opportunity here, as a lot of these casinos have been beaten up and very focused, heavy focus on momentum, just looking for continuation of momentum. If we go out 1 week and 1 week only, or go out into the, give it a 2-week move, this is a relatively tight trade. But specifically, what we're looking to do here is look for next Friday. You could trade right around this 36.50 level, $36 level, forgive me, $36 level for August 29th, and then selling up at around the $38 level. So relatively tight spread here. But the trick here is to protect yourself. And I'm not going to quote Wu-Tang Clan this early in the morning, but let's just take a quick look at what we would be looking for on this type of trade. So specifically with a company like MGM, currently trading at $37. Nice move today to start the day. Just to give a general roundup of what we're looking to do here. That 20-day moving average is somewhere back around 36. Now, obviously, the numbers need to be adjusted accordingly, and I don't have a Black-Scholes calculator on me at the moment. But if you buy the 36 and you sell the 38, let me show you what happens when you make this type of trade. The numbers are going to be a little bit off because of the way that this is structured. But let me just pull this back, and I'm going to put this at yesterday's numbers just so that you can see the way that this sets up. The reason that I'm setting it to yesterday's numbers is to give the example and showcase how the math operates if the stock pulls back to a certain level. 20-day moving average moving up higher, let's say 36.25 effectively becomes the stop. This is how much you know you can lose right up front, 20% downside. You want to make sure that you keep a close eye on that and you cut it. But if the stock continues to carry momentum in the next 2 to 3 days, the upside here is somewhere 30, 40, 50, 60%. And that's all you're really looking for. So again, it's going to be adjusted differently, but we're looking at the $36 call and the $38 call. You can also use the $36.50 call and sell the $38.50 call. And again, we do these spreads because if this does roll back, a straight spread will provide you a little bit more protection to the downside. And I'm going to give you a real quick example of why this is the case. In the event that this goes out the next Friday, your break even is 36.89 based on yesterday's math. Obviously, the break even will be a little bit higher. But you can see right here at 42%, that is your probability of profit. If the stock were to pull back to that 20-day moving average, you see what you could potentially lose. That's going to be where you exit. It is a mental stop, okay? But if you were to buy simply the call on the $36 level, taking a look at this from yesterday, just the $36 level, what you have here is a situation where you're going to be a much lower probability of profit, about 1 in 3. And if the stock pulls back to 36.50, you've got about another 10 percentage, 500 to 1,000 basis points in loss, right? Percentage wise, it could be impacted as a result. So the call that you're selling based on those technicals and based on the fact that we're focusing again on just trying to retest back to previous levels, that just gives us a little bit of a buffer. And if it doesn't make it, you just let it go and you take a relatively short stop and you get out of the way. All right. On the downside, Palantir. Wow. Funny. Bad things happen to big tech stocks under the 20-day moving average. And it's a reminder that when these stocks break, one of the cleanest trades is just simply looking to go 20 to 50, 20 to 50, 20 to 50, over and over and over again. And it came yesterday with a very sharp move down. Now the key issue with Palantir is, will it continue its breakdown? This has been a sizable move down, obviously on the back of 189 all the way down to 150. Momentum tends to beget momentum, and this is probably a stock that has seen an increase in leverage use over the last couple of months as it has continued to rise higher. Once again, as I look at this, remember, there are other things that you can trade outside of Palantir, just the stock. Remember, anyone who was in the Tesla boot camp with me, I've explained that there are proxies, there are other things that exist that you can trade in the event that you want to short some of these names. And what is out there? Well, Palantir just so happens to have inverse ETFs, right? There's actually going to be a triple short Palantir ETP. I think it's called 3SPA that's going to be coming out on the London exchange. But right now there's something called PLTZ. Okay, this is the Defiance Short ETF on Palantir, and it just came out, and it just shows you this is the beauty of the United States right now. We don't make anything except for inverse and leveraged ETFs anymore. This is what our engineers do. We don't build bridges, we don't fix roads, we don't put anything else up. We just go to Wall Street and we say, hey, let's make a bucket of insanely leveraged companies. Let's wrap them around some derivatives, and then let's sell them to the public and collect some percentage points each day as we watch them trade like maniacs. Well, at the end of the day, we have this pop moving, and this goes back simply to volume weighted average price, PLTZ, Be paying a very close attention to this. If Palantir does rebound this morning, but does start to break back down and roll back over, PTLZ can be a nice day trade vehicle simply by using volume weighted average price. Not a buy at the moment, but as I'm just going to talk about ideas, if Palantir does get a morning wake up call, gets back to around, and PLTZ gets down to around $10 or gets down to around 978, that's where Palantir is probably going to roll back over and continue its ongoing down cycle that it has been in for the last couple of days. And that makes PLTZ a fun thing to trade during the day because, as you could see, as Palantir is moving lower, PLTZ is moving higher because of the leverage and because of the inverse nature of it. Yesterday, going from 857, finishing the day at nearly $10. You can do a lot with that without having to even own the options or anything else. So just be aware that these things exist and that the volume weighted average price is there to help you in the process. Yesterday, I had to get out of a trade yesterday with a company called Asana, and took a very relatively smaller gain. But Asana is a company that is absolutely terrible at what they do. I don't understand what they do. I think they're in software. All I know is that Dustin Moskowitz keeps buying his stock and it keeps going down. So once again, as we look at the weakness that has come on the backside of this nice little pop that it's had over the last couple of days, looking at our daily chart back under the 20-day moving average, had been long Asana. Now turning around after taking about a 22% win on Asana, looking to go to the downside. Same rules, everybody. Buying at the 14, selling at the 13. Buying at the 14, selling at the 12. Pretty simplistic, right? Pretty simplistic. Down 10% today. So we could just talk a little bit about what that looks like in this, just giving you some ideas. We're looking at put spreads at the moment. ASAN across the board, 1375, currently at 1380. If I go down 2 weeks and look at Asana at $14 and then turn around and write the 12, which is what I was just discussing, that's going to give me a $1 spread. 1308 becomes the break even, 39% probability of profit. But once again, if the stock starts going up, if it starts to rebound, if it moves back above, say, the 50-day moving average, I know exactly what my potential losses are on that trade, and I will remain disciplined to them. So at 1350, 20%, and that's where I want to start to cap out. 1440 is about a 21%, and that's where you see on probability of profit what your potential losses are. If the stock does break down in the next 2 to 3 days and gets walloped on the backside of Jackson Hole, you know what your range is all the way down to the $12 level. On the momentum side, Tilray Brands. Well, you're still around. All of these stocks, companies like TrueLeave, all the cannabis stocks, what's the marijuana stocks? They continue to gain momentum because in the background, all of the conversations that people are having around the Jackson Hole, we still have other policy that is being done, and we're still seeing a lot of movement on stocks that are tied to the cannabis space. And it's not just companies like Cronos, right? Very strong momentum, very strong moves on some of these names. There are other names that people should be paying a lot of attention to. Altria. And I know that cannabis would be a very small component of what the company does at first. But the long game of the cigarette companies is going to be to take over the cannabis space, full stop. Companies like AbbVie, right? These are the backdoor cannabis stocks. These are the companies that are engaged in this. And these are the companies that are seeing growth and success. Constellation still breaking down, but in the cannabis space, pay very close attention to Tilray, MAPS, and of course, CGC, Canopy Growth, as this hovers at this 20 and 50-day moving average. These are the types of stocks that just go quiet for a little while and then pop. And once again, that is why you need to be joining Gianni today at 2 o'clock. He's going to discuss freeze points. A lot of opportunity. All right. Not going to have enough time to dig too deep into some of the tickers. I apologize because I want to talk about SARK. Again, Don is short ARK. I'm short ARK. And one of the other ways to trade ARK rather than trying to use options, if you don't want to use options, and you don't have to use options, I want to stress that. You don't have to use options if you don't want to. When I was a kid, I was 5 years old. I was in preschool. I didn't want to take a nap. My dad said, well, you don't have to take a nap. And then the next day I went in and I stood on my cot and I said, my father told me I don't have to take a nap. And then they told me never come back. Well, I promise you, we will never say to you, never come back if you don't want to trade options. You can use the power of leverage using other tools. You can use inverse ETFs to short stocks. You don't have to borrow stocks to short them, sell them into the market and buy them back. The innovation, if that's what we're going to call it, while the alchemy and financial engineering of Wall Street have given us the opportunity to short a number of different equities using tools that are created to produce inverse returns based on decline in the underlying. So for every 1% that ARK goes down, ARK Innovation Fund run by Cathie Wood, SARK goes up 1%. And as you can see, there's upside here. And if this has been breaking its 50-day moving average, some beautiful magic has happened with SARK. I do like to get in on it at the 20-day moving average. I do like to hold it. And in the event that it pops back down to that 20-day, keeping a mental stop, just simply walking away from the position. Not a big deal, but again, there can be some significant breakouts. And for anybody who is potentially looking for the even more insane high octane way to try to short ARK. Remember, TARK exists, which is the long innovation ETF. And interestingly enough, there is an options chain on some of this stuff. Last couple of things just to talk about as you're looking at the horses to watch, just to let you know, tariffs driven steel bid on the first ticker, the STLD, benefiting from new metals policy shifts. We have a lot of focus on a lot of these commodities right now. Alcoa holding. This is one of those stocks that's just kind of trading sideways, is consistently hovering and holding above that 50-day. We will be looking for direction on that relatively soon. And finally, just want to add SD and Sandridge Energy. This is a difficult one because the energy sector right now is negative. We're seeing weakness. We're seeing a little bit of a pop in oil prices this morning. But the core thing here is just to know that there was insider buying on Sandridge. It also fit our quality value momentum screener that we run during our live sessions in our member room. So this is something to pay very close attention to, because if SD does break down in any way, if the rest of the market does break down, I want you to make a mental note around the fact that the executives, the director bought 265,000 in shares. It's relatively rare that we see insider buying on this company. And the reason for this is just noting, hey, 1096, kind of a line in the sand. It's an unusual insider buy. Insider buying is not happening again very often, and it can just be a sign of something, a catalyst in the near future, or something positive for the business. I don't know too much about it. I'll dig a little bit into it for our session later today at 9 o'clock. At 3 o'clock, I have 3:30. Wow, 3:30. I'm back at 3:30 today. Got a lot of trading to do. That's exciting. So, a lot of ideas, right? EPAM, how to trade MGM, how to trade Palantir, how to trade Asana, different ways to utilize inverse ETFs. We continue to see a breakout on healthcare stocks, real estate doing well, technology continuing to weaken. And that's why we got to be paying very close attention to the FNGD and the S&P 500. I also want you to keep a very close eye on one last thing, and that is the TECS, which is TEX. And TEX is the inverse bull ETF, inverse bearish ETF on technology stocks. If this starts to break above its 50-day moving average, that can also signal continued weakness in the S&P 500, which is heavily dominated by technology stocks. It's 9:19. You know the score. I hope you guys are having a good time. Appreciate you, Edwin. Hope you're having a good day. Enjoy your call. Hope everybody's enjoying their day. Weeds, CNBS, Scott's talking about in the Scott. Sold out a little bit early. Okay, that's awesome. Good to know. And I know that Bierman's all excited about Tilray. Again, everyone, 840. Why can I not do anything with this screener? Okay, 1 second. There we go. Sorry. Way to recap. Again, look at the success we had today as shows. Sometimes the biggest market gains that you have are the friends you make along the way. As we move into 9:30, Don's going to be coming back with some music. I encourage you to be in with Gianni today at 2 o'clock to talk freeze points. I hope everybody has a great trading day. I will be back at 3:30. And if you do not see me later today, well, I will be back at 8:45 for Market Masters as always. Have a great day, everybody.